Something just happened. Quietly. No massive headlines, no flashing breaking news banners on CNBC, but with a force that could fundamentally change the Bitcoin market over the next few hours and days. Just a few hours ago, the U.S. Treasury confirmed that Bitcoin will not receive a bailout in the event of systemic market stress. No TARP. No rescue package. No safety net. Bitcoin stands alone. And this is the moment most people are underestimating. While you might be looking at the chart and only seeing Bitcoin recently testing support around $65,000, something very different is happening beneath the surface. The market is starting to realize that this time, no one is coming to save it. No central bank. No treasury. No too big to fail. And this is where the game begins, the game you don't see. Historically, moments like this are extremely rare. In 2017, it was pure euphoria. In 2020, it was panic followed by an unprecedented money-printing frenzy. In 2024, it was institutional validation through ETFs. But now it's market discipline. Raw, unfiltered market dynamics. Supply versus demand. And that's exactly why this Treasury statement is so explosive. Because what happens when a market truly understands there is no bailout? Leveraged traders start to get nervous. Funding rates flip. Stop losses sit just below current price levels like a line of dominoes. And while retail is still debating whether $65,000 holds or not, the whales already know what's at stake. On-chain data has been telling a very clear story for days. Large wallets are barely moving. No panic. No distribution. Quite the opposite, accumulation at elevated levels. Addresses holding more than 1,000 Bitcoin remain calm, almost eerily calm. Meanwhile, activity among smaller wallets is increasing. This is exactly the pattern we've seen in previous cycles. While you're panicking, someone else is quietly accumulating. Then this Treasury statement drops like a match thrown into a dry field. The market realizes something crucial. Bitcoin is not a rescued asset. It's a ruthless asset. If you're positioned wrong, you get liquidated. Period. That's not a flaw in the system, that is the system. If we look back to March 2020, we see both similarities and key differences. Back then, the crash came first, but the money printing followed. Bitcoin fell, but the narrative was saved. Today, it's different. Today, the state is openly saying, we will not intervene. In the short term, that means volatility, maybe even a final capitulation among over-leveraged traders. But long-term, it means something far bigger. Bitcoin is being forced to grow up. Right now, the market looks like a beach ball being pushed underwater. The deeper it's forced down, the more energy builds beneath the surface. And this is exactly where institutional players start paying very close attention. ETF flows have slowed recently, yes, but they haven't turned into massive outflows. That's critical. No mass exodus. No panic flight. Just waiting. In the derivatives market, we're seeing a dangerous kind of calm. Open interest remains elevated while volatility compresses. This is the classic setup for an omega candle. No one knows which direction it will explode, but it will explode. And moves like that don't come from news. They come from positioning. The Treasury statement acts as a psychological catalyst. It strips away the illusion that Bitcoin is part of the old system. And that illusion was never real to begin with. Samson Mow has said it many times. Bitcoin is not a risk asset. It's an exit. But that exit isn't comfortable. It's brutally honest. At the same time, globally, we're seeing a very different picture. States and state-adjacent entities are quietly building positions. Not out of greed, but out of necessity. Inflation remains structurally high, even if official numbers try to suggest otherwise. Money is losing purchasing power. Trust in systems is eroding. And Bitcoin stands there, unrescued, unprotected, but also undiluted. Glassnode data shows that an ever-growing portion of supply hasn't moved for months. Long-term holders are not selling. They've survived far worse storms. 2018, 2020, 2022. They know this game. They know the market is trying to shake you out. And right now, the critical question emerges. Is this Treasury statement the beginning of a panic wave, or the moment Bitcoin shows its greatest strength? Historically, the strongest moves have always come when sentiment was at its darkest, when consensus was maximally pessimistic, when everyone believed the narrative was dead, when no one expected a rescue. The next 6 to 12 hours could get uncomfortable. Liquidations aren't predictions, they're mathematical consequences when leverage gets too large and confidence cracks. But panic is rarely a good advisor. The market is playing a game you don't see, and right now it's testing who truly understands what Bitcoin is. Arkham data suggests that larger players are preparing transfers, but not toward exchanges. This isn't selling behavior. This is strategic repositioning. Meanwhile, social media feeds are exploding with fear. That exact disconnect is what professionals look for. Bitcoin will not get a bailout, and that's precisely why it may emerge from this stronger than ever in the long run. No rescue means real price discovery, real scarcity, real responsibility, and yes, real volatility. If you've made it this far, you're no longer just looking at a price. You're seeing structure. You're seeing psychology. You're watching a system under stress. Let me know in the comments whether you think the market can handle this truth, or whether we still have to pass through fear first. Drop a like if these insights help you, and join the discussion, because opinions formed right now often look like prophecies a year later. Because one thing is certain. After this moment, Bitcoin will not be the same. And the question isn't if the market reacts. It's who is prepared when it does.